session on income statements. This is for GCSE business. So income statements are sometimes called profit and loss accounts because they show whether the business or the company has made a profit or a loss. Now, before we get into the details of the income statements and each of the components within it, and we'll explain each bit there, firstly, we need to look at why do them. So there's 5 reasons why you might want to do income statements. The first is legal reasons. So it might be that if you make a profit as a company, then you'll be eligible to pay corporation tax, and tax clearly goes to the stakeholder that is the government, the big G. Number 2, compare to previous years. So it might be that managers will want to compare to previous years of how the business is doing. Is the business evolving? Is the business worsening? If the business is worsening, then management might want to put a strategy in place to try and allow the business to make better profits in the future. And it would be the income statement they look at. Maybe they look at sales revenue increasing that, or cost of sales and reducing that. So management would care about previous years, and they'd also care about the rivals to the business. So you might want to look at the business, the company that you are, from the manager's perspective, and then compare to other businesses, other companies within the industry that you operate in. Are you above average? Are you below average? Are you the best there is in terms of profits? And that's useful information for managers. Number 4, current investors, well, they might want to know how the business is faring. They might want to see the business making profits because that could mean dividends for them. So shareholders will care about income statements. And also potential shareholders will care about income statements because it might be that they see that net profits are increasing, they're trending upwards year after year, and that might be exciting for potential investors. And they will become actual investors if that were the case. Now, let's go through income statements and all the components within it. So let's go through the various components of the income statement. So the first thing to note is always in the same order. It's always sales revenue, cost of sales, gross profit, operating expenses, net profit, always in that same order for GCSE business. Let's go through the first thing. So the first thing is sales revenue will always be at the top. Sales revenue might be called revenue or turnover, and that's just the sum of all of the products, and when you take the price times the quantity sold for each of those products. So sales revenue. Sales revenue for this business, 2023 Sesh Hats, is 200. That's £200,000. £200,000. Note you see 000, that means thousands. It might say M, that means millions. So it's worth checking that out because you don't want to drop a silly mark there. Now, after sales revenue, you've got cost of sales. Cost of sales is the costs directly attributed to the product. So the product in this case is hats, so materials would be a cost of sales. You can directly attribute that to the product. Now, you might want to check out the fact that there's brackets there, because it's brackets because it means negative, because cost of sales is something you're taking away from the revenue, so it's minus 50 effectively if it's in brackets. And so therefore, you're going to get to your first profit because £200,000 take away £50,000 leads to £150,000, and that is your gross profit. Gross profit, that's the first type of profit. The next thing we need to take away, though, is not just the costs directly attributed to the product, but the costs indirectly involved in the process. So the ongoing day-to-day costs that are not directly attributed to the product. That could be the marketing involved, the insurance involved. There's lots of operating, that means basically day-to-day, expenses involved. And it could be, in this case, this fictitious example, that the operating expenses for this business is £100,000, and it's clearly negative, so we need to take it away. So to get to our final profit, which is net profit, we go gross profit, £150,000, take away operating expenses, £100,000, which gets to the second type of profit, which is net profit, and clearly net profit is going to be £50,000. And the difference between gross profit and net profit is gross profit is just taking the cost directly attributed to the product, but net profit is taking both the cost directly attributed to the product and also all the other day-to-day costs involved, being the operating expenses. So net profit is also seen as a better type of profit to analyse the overall performance of the business. So there we go, we've got the income statement there. Other things to watch out for are some analysis tips when you're looking at this, because there might be longer questions and you might be expected to do a little bit of digging around the income statement. So the classic things to look out for. So number 1 is the cost of sales we're talking about here. So the cost of sales increasing is not always a bad thing. It's something to watch out for. It's not always a bad thing, because if sales revenue is going up, so in this case you're selling more hats, then it would be expected that the cost of sales would go up because you'd need to be making more hats, producing more hats. So always watch out for that. So cost of sales increasing is not necessarily always bad, because it could be a result of sales revenue increasing. Number 2 is reducing cost of sales. So maybe a business is not making the greatest gross profit or net profit, and they need to bring down their cost of sales. If you bring down your cost of sales, then you might want to analyse the fact that they might be doing that through finding a cheaper supplier. But does the cheaper supplier worsen the quality? Do they worsen the reliability, particularly if they use just-in-time, for example? So something to watch out for there if that's the way they go about it. Number 3, increasing marketing. So if you increase the marketing is not part of the hat in this case. It's not a direct cost, so it's clearly an operating expense. So it will mean your operating expenses go up, so it has no impact on gross profit, but it will have an impact on net profit if you do marketing. But of course, it might lead to the fact that your sales would go up. So it would lead to higher sales revenue, and that would impact your gross profit and your net profit. Number 4, gross profit and net profit. Well, you're going to use them for ratio analysis. More details on ratio analysis, that's gross profit margin and net profit margin. Click the card up there. See you at the next sesh.